Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host Shafiq Morton, and always it's good to be with you. In today's show we have a look at global and local markets and the impact that they could have upon you as a consumer and as an investor. 2016, as we all know, we saw a myriad of changes, and it's expected that 2017 will probably be no different. In studio with us today are Isma-el Ebrahim and Daniel King from Oasis to help us understand and to unpack what all of this could mean for us and what we need to know. Isma-el and Daniel, welcome to the show. Assalamu alaikum.
Thank you very much.
Daniel, Donald Trump was elected as US president. I think we all know that. He's in office, he's been signing a lot of things, and it seems like he wants to change a lot of policies. How do you think all of this is going to affect the US economy, the global economy, and I think pertinently our local economy?
Yeah, Donald Trump presents quite a significant degree of uncertainty into US global economic forecasts over the next year, because it's not often that we've seen such an unpredictable and unorthodox president at the helm of the United States. On the one hand, it could be relatively stimulating for the economy of the US because he's got some ideas on infrastructure spending and tax cuts that could actually provide a boost to investment spending and the consumer wallet in the short term. And there's actually a valid case to be made that the US economy needs a bit of infrastructure spending because of the aging of their infrastructure over the last decade. But on the other hand, there's a very genuine concern about his views on international trade because the opening up of US borders to places like China and Mexico has done a massive amount over the last 3 decades to bring consumer inflation down, to bring prices under control in the US economy. There were significantly higher on a year-on-year basis rate of inflation in the 1970s, and now you're seeing US inflation consistently below 2%. A lot of that has to do with the opening up of their borders, the process of globalization of international trade. When you allow companies to source goods and services globally instead of from within your domestic borders, they obviously are able to pursue the most efficient producers, and that way you can control costs a lot better. Now, when you reverse that process, you effectively undo that price efficiency. So the immediate impact of putting up barriers to trade through tariffs would be that price inflation could go up. So there's clearly not a good impact on the consumer wallet that comes out of that higher cost pressure in the economy. A similar argument can be made for immigration flows. For example, in the US we see the workforce in sectors like agriculture, like construction, cleaning services. More than 10% of the workforce in those sectors comprises undocumented migrants. So these migrants typically earn 40% less than native-born US people, as well as documented migrants. So if you effectively just kick these people out of the country, you're going to have to pay significantly more for your workforce. And that's an inflationary force in the economy at large. So you've got this offsetting impact on the consumer wallet that may undermine the positive benefit from an infrastructure spending program or tax cuts. So we do believe that the jury is still out on whether Donald Trump is good for the US economy. There's a significant amount of uncertainty around forecasts, even over the next year. It's definitely not unambiguously good for US growth because of that conflict between more infrastructure spending, but also higher inflation, very potentially. Now, in the months following the US election, the global stock markets actually were relatively strong. And that effectively meant they were betting that on the infrastructure spending side, he would have a lot more buy-in, and it would be a lot easier to push that through the the two legislative houses with the White House backing. Whereas on the immigration and on the trade side, because there would be less buy-in from more moderates in the political parties, that it would be more difficult, and effectively you'd have quite a healthy balance of policy to boost the US economy. But we've seen from his first month or so in office that it's possible that the opposite is true, that the anti-trade, anti-immigration measures are pushed through by executive order, whereas your infrastructure spending is limited by budget constraints in the United States. So it's certainly something that we'll be tracking for the entirety of his term in office. And we do believe that it could go either way, and there's definitely a greater degree of uncertainty that investors need to protect themselves against over the next year.
Isma-el, last year we saw Brexit, and that was certainly a dramatic event. This year there are a number of elections in the whole European zone. Can we expect any more surprises this year?
I think it will certainly be an interesting year. It's not without its fair number of elections. We've got the Dutch elections, French elections, German elections, either general or some sort of federal election. So there is a fair amount of, let's call it, action happening this year. In each of those countries there's also a fair proportion of the economy that has moved towards right-wing, or fair proportion of the population that has a right-wing voice. But having said that, they're still probably around 15 to 35% of the total population. Now, we've learned our lessons from the last year, where there's been a number of, let's call it, electoral upsets, where that might be Brexit, where that might be what we've seen in the US, where a few number of swing states actually caused one of the biggest upsets in political history globally. So, you know, I don't think anything is, we mustn't think anything is unexpected, but we also have to look at what the root cause is of the issue. And ultimately, it's been a slow financial recovery, or slow economic recovery, and also rising income inequality that has caused these voices to start sort of making more noise. And then ultimately, with 15 to 35% of, let's call it, the vote, in order to make a real impact, even if they are the majority, they might still need to do some sort of coalition, which will rein the right-wing vote in. But I think ultimately we need to, globally, the root causes need to be addressed, and as soon as global economics are sorted out, I think those voices will tend to die down.
Now, Isma-el, we've seen the political landscape changing dramatically. We all agree on this, but China is always there, either in the foreground or the background. China is on everybody's minds, as it were. How do you see things going forward in terms of the world's second largest economy?
Certainly China is a completely different animal to what we've seen over the last few decades, where they've been very inwardly focused, sort of focused on increasing urbanization. You know, they've managed social sort of thought processes through tightly controlling the internet and the media. And historically, it can also be seen as the legacy of communism. However, recently, and more recently, as recent as last month at the World Economic Forum in Davos, where their President Xi actually started talking about globalization and came out very strongly in support of globalization. And I suppose that's a big shift for an historical communist nation and one of the biggest nations in the world. So I think that was a strong message of the shift in intent. And increasingly, so with them focusing on globalization, increasingly, you know, they've decreased their regulation. There's still a fair amount of regulation, and that's going to be an interesting way it plays out going forward. I think it's also important to follow the relationship between China and the US. Remember, those two, historically, China and the US are each other's biggest trading partners. And China, obviously, the Trump administration now having come in, has previously made a lot of noise about reducing their trade deficit with China. A large amount of US imports obviously come from China. So President Xi and the Chinese are going to increasingly have to play that relationship very, very well. And it will be interesting to see how that plays out going forward. I think another important consideration about China is the rapid growth in private sector debt over the last few years. That has had a meteoric rise. And you know, if the economy were to stutter, we could see a credit crunch. But historically, we've seen every time the economy has sort of shown signs of stuttering, the government has stepped in to sort of prop up the economy, and they do have a significant amount of reserves with a very positive current account balance. So that's actually been supportive, and I think that theme will continue to play out, where every time the economy slows down or there is a stutter, the government will step in. And then importantly to note is China is growing at 6%. For one of the world's biggest economies, that is a very strong growth rate. And if you compare that, I mean, look, compared to South Africa, we're a smaller economy, it should be easier for us to grow. We're only growing at less than 1%, probably 0.5% or 0.4% for 2016. So very, very slow growth for South Africa, China growing at 6%. Naturally, that growth rate will slow down. It can't grow at that rate forever, but I think it will be a managed process from 6%, and there will be a natural slowdown, but it will be managed.
Daniel, let's get back to South Africa. Obviously, we're affected by everything. We're affected by the US, we're affected by the Eurozone, we're affected by China. Last week, Sona said that China first policy is paramount. How does this play into the South African local economy?
South Africa is quite heavily reliant on international trade with all of the regions that we've discussed, the US, Europe, and China being our single largest trade partner. So both on the import and export side, we're affected by any uncertainty that's experienced in these countries. It impacts us directly. But it's important to remember that under current baseline views, over the next year, most economists do expect the world economy to do a better than 2016. So basically, it's underpinned by that bet that the United States is going to be stimulated by an infrastructure spending program, by tax cuts, and China will remain relatively stable. And that's good for our industrial sector. On the export side, it keeps commodity prices relatively stable, so our mining sector should do better than last year. And through that, it creates a more stable investment environment across industrials in general. We also see the agricultural sector coming off quite a deep drought in 2016, and there's a good positive growth impulse that is likely to come out of that. As long as we can contain some of the risks around the maize crop this year, we should see an improvement in the agricultural side. On the consumer side, the primary channel through which international conditions might affect us is through inflation. If we see the rand stable at around 13.50 to 14, while global oil prices behave, we could plausibly see inflation come down all the way to 5% this year. On the other hand, if the rand does depreciate quite significantly, or if oil prices globally go above 60, you could see inflation sticky around above 6%. And that would force us to kind of reduce our expectations of consumer spending in the year ahead. Over the longer term, I think the shifting global forces that we've been discussing geopolitically will mean that global alliances like the BRICS will become more important in terms of stimulating trade flows, maintaining trade flows, and to the extent that rising nationalism and anti-globalization gains more traction, there might need to be a focus on more of an internal market, and that would require that we address some of our structural constraints so we can develop our own internal market through obviously improved productivity, through improved education, addressing the issue of unemployment and income. But it really is quite uncertain at this stage and relatively difficult to forecast with any degree of confidence, which way this anti-globalization nationalist sentiment will ultimately shape global conditions and South Africa.
Isma-el, to start off with you in the second segment. Last week we saw the State of the Nation address in Parliament. Apart from the violence, are there any constructive takeaways from the actual speech that we can look at?
Look, if we look through all the noise, I think the gist of it and the overall tone that came through was there was a focus on three issues, I would say. Energy being one of them, investment promotion, and then also regional integration. On the energy side, there was a renewed focus from the President to push through the IPP programs, and he sort of suggested that he will sign the next round of programs, and also going forward look to include the likes of other than renewables, the likes of coal and gas. I think that's a positive. Then if we look at investment promotion, he once again reiterated what was raised last year was Invest SA, and it looks like they've made some progress now looking to set up some regional centres in Gauteng, in KwaZulu-Natal, in the Western Cape. And I think that's also important, and it continues to bring across the message that South Africa is open for business, and that's at least consistent with what they've spoken about last month in Davos. And then finally, on regional integration, I think there's a renewed focus on the overall Southern African region, SADC and COMESA, and continue to look at opportunities to look at community free trade in the region. That will obviously not only benefit South Africa, but also our neighbours, which are also very important to us as trade partners. And then there are other sort of peripheral issues, but also on a more socio-economic front or more populist front, there's been a renewed sort of focus on looking at addressing economic concentration, addressing the fact that government or big state enterprises should look at introducing 30% of their subcontracting to black-owned entities, establishing, the black industrialists by looking to get them more involved in manufacturing, in industry, opening up factories and that sort of thing. So it looks like there'll be a lot more facilitation in that regard. I think overall the underlying tone, and if we compare this to previous State of the Nation addresses, it was very focused on the way forward. It was focused on what the topics are that we're going to get through. And I think a key one is actually also a bigger state involvement in the mining sector. So it looks like what's going to happen is the state is going to take bigger active participation, whether that may be an equity participation in mining entities. And then there's also been talk about, creating a state mining champion in South Africa. And I think that would probably have a lot more momentum going forward, judging from the speech. Overall, I think the speech was focused, and it was sort of, these are the topics we can look at going forward, and we should monitor those for progress going forward, and I think that will be important.
Daniel, on the 22nd of February, we see the budget speech. I suppose, in a sense, flesh is put onto the bones. What do you think we can expect from that? And I think what a lot of people are asking questions about, the tax landscape.
During the October medium-term budget policy statement last year, you may remember that the finance minister actually committed to raising an additional 28 billion rand in the February statement this year. So that is a lot of money. It's going to be raised through either new or just higher taxes in one way or another. It's unlikely that he will renege on that commitment because they've put it as a line item in the budget itself. So it's highly likely that South Africans will be paying more tax this year. Obviously, the key question is how he will achieve that. There are a few options doing the rounds. VAT is one option. A 1% increase in VAT can raise as much as 20 billion rand, and that's a big chunk of the 28 billion. It's politically difficult to do that, however. Obviously, they might go other routes such as the fuel levy. A 1 rand increase in the fuel levy can also take a big chunk out of it, adding about 18 to 20 billion rand as well itself. So between VAT and the fuel levy, that's quite a powerful lever that he can pull. There may be a new personal income tax bracket for the very high income. So in last year's budget statement, there was a table included in the actual document which showed the number of taxpayers per income band. And it showed the power of increasing the tax rate for those earning more than 1.5 million. We may see a new tax bracket in that range with a higher tax rate, marginal tax rate applied. And then there's also the simpler option would just be through fiscal drag, what we call fiscal drag, which is the idea that a government won't adjust the tax brackets for inflation, or they'll adjust it by less than the rate of inflation for the year. And so as people receive their annual increases in line with inflation, or even higher than inflation in some cases, they will inflate into a higher tax bracket. And that in itself can raise as much as 13 billion rand or so. So there are a number of different levers that they can pull. All of them are very plausible that I've mentioned, which the finance minister could pull to raise that additional revenue. But one way or the other, 28 billion rand is going to mean a sizable tax increase. We're also expecting in the budget an update on certain structural reform issues, how the government has been managing to stave off a credit rating downgrade and put that credit rating on a stable outlook. It's currently on negative. Obviously emphasis on the labor relations environment and how that has improved, and then further promotion of South Africa as an investment destination. We don't expect much more color on things like the NHI, the National Health Insurance Scheme. It was mentioned in the State of the Nation address, but that is a very long-term project that doesn't yet, in terms of financing requirements, doesn't yet really come into the budget, the medium-term budget framework. And we don't expect much on the nuclear build program either yet, before the political backing is there, and also before the proper due diligence is done on the costing.
Daniel, we are definitely seeing belt tightening from Treasury, no doubt about that, but there does seem to be some hope by economists that the repo rate might go down in 2017. How could that play out in terms of consumer debt costs?
Yes, there are some economists who are now forecasting that the Reserve Bank will perhaps even cut its repo rate by the end of the year or close to the second half of the year, But that forecast does depend quite crucially on uncontrollable factors like the rand, the global oil price. As we've highlighted, if that moves sharply one way or the other, it's going to affect the inflation forecast, and it can change the repo rate outlook completely. Having said that, the SARB, the Reserve Bank itself, has said, look, under current conditions, we probably are at least near the end of the so-called hiking cycle. And under current conditions, should things stabilize, we're not looking to hike the interest rates any further. But you must remember also that the hurdle for cutting rates, for actually going into a cutting cycle, is also quite high. So the Reserve Bank would need inflation expectations or the inflation forecast to fall to 5% or so and below before they start considering cutting interest rates. And that's actually quite a big ask, because many of the CPI, the inflation basket items, are quite sticky above 5%. Housing and utilities, your own rental escalations, if you may be renting, you'll notice will increase year in, year out at above the rate of inflation. Financial services inflation, insurance inflation, easily exceeding 6% year on year, consistently. Food inflation, even when commodity prices come off, your retailers tend to actually just increase margins. So it's quite difficult without an oil price collapse or something like that. It's difficult to get your inflation forecast below 5%. And on that basis, it may be very difficult to cut the repo rate, even though it may remain stable. The second point is that global forces, as I said, global forces are very important. So if the US economy starts humming this year and there's more inflation in that system, what we'll see is their Federal Reserve Bank will start hiking their interest rates. And unless we keep up with them, almost one for one, you could see some rand weakness and then some emerging inflation pressure again, because imports become more expensive. So it's going to be a complex story. While some see the potential for some cuts over the next year, we do believe that it's far from cut and dried, and there is scope for that to move either way. But we do acknowledge that the Reserve Bank has said if they can control it as far as possible, they will not be looking to hike any further.
Isma-el, to get to you, the ruling party faces some big hurdles in the future. This year we've got a policy conference. There's a leadership struggle that's taking place internally even as we speak. Now, is this, number one, going to increase volatility in the markets? And number two, if that does occur, how do we protect our wealth?
I think actually a point that I wanted to raise earlier, and just touching on that, on policy, I think the overall tone from the SONA last week was also that it suggested that policies, we can see that some of the policies that have been taking a while to get through would start to come through, and that would create policy certainty. In terms of the political volatility and the political landscape, yes, we do have two very important dates this year, one in the middle of the year and one towards the end of the year, where they do the presidential election conference. And I think those two are important because that will also once again shape policy going forward. And why is policy important for markets, for investors? Is because it then enables you to understand what the direction of the economy is going to take over the next few years. Policies generally play themselves out over a long period of time. So yes, South Africa is completely politically complex. It's very politically complex. And we've seen that political sort of developments do have an impact on markets. I think the most obvious analogy would be to draw one to what happened in the UK, where after Brexit, the pound, got completely smashed and just devalued. Another example would be, the development on the US economic front. So yes, politics do have a role to play in markets, and that could cause some volatility going forward, especially since it's going to be big decisions that are going to be made. Who's going to be the president of the ANC, and ultimately that will be the candidate for president of the country. And who that is will then shape policy and have implications on investment. How do we see this? So with political volatility, how do you invest to protect your wealth? I think increasingly there will be volatility, whether that the key thing about volatility is even though you might have a short period of volatility, it could completely wipe out your wealth. So that's why it's important to invest professionally as well as systematically. So you should always have a plan, and you should always incorporate diversification. So at Oasis, if we look at our investment philosophy, and it comes through in our track record, how we manage things is we look at those companies that continue to perform through the cycle. Our overall investment strategy looks at things that incorporate strong balance sheets, strong management teams, companies with competitive advantage that reflect in margins. So even through volatile environments, they continue to outperform. And that also shapes our investment philosophy. Our investment philosophy and our objective is to protect and grow the real wealth of our clients through the cycle. So even though you've got volatility, our objective is to ensure that when there is volatility, we protect your wealth from that downside. So a key element of our investment strategy is also diversification, whether that might be geographical, sectoral, instrument, asset class diversification, and through diversification, you then protect that, managing our clients' wealth in line with their return objectives, but also taking into account their risk appetite. Ultimately, that has come through in our long-term track record, and it's important also to bear in mind that when one invests, you are investing over the long term.
Isma-el and Daniel, thanks a lot.
Thank you.
And a special thanks to our guests in today's show, Isma-el Ebrahim and Daniel King, in which we were discussing the global and local economy. Of course, this is a very convenient background for the budget speech delivered in Parliament by Minister Pravin Gordhan. Join us 2030 on the 22nd of February for a special live broadcast in which we will unpack and analyze the 2017 annual budget speech. Should you wish to contact us, you can dial 0860 100 786, or should you wish to watch this or any of our other shows, you can log in to the Oasis Crescent YouTube channel. From myself, Shafiq Morton, until next time, Assalamu alaikum wa rahmatullah.